Let's get right to Mish Schneider, Director of Trading Education and Research at MarketGauge.com. Mish, great to see you. Thank you so much for being with us as we see the technical levels breaking apart a little bit because we had Friday's sell-off and we're checking on another sell-off. In fact, the NASDAQ in 5 days is down about 5%. The S&P and the Dow are down 3 and 4 days with the biggest sell-off in 2 months. I mean, it shows you that we're breaking down a bit here.
Well, what's so interesting, Nicole, is if you don't know how to read a chart, this year has been so classic in terms of how it's followed the technicals, not just in terms of price readings and moving averages, but even things like oversold and overbought indicators, McClellan oscillators, so to speak. So essentially, that's exactly what we saw. We saw great oversold conditions, although the macro and nothing about the macro changed back in June, July. And it cleared the 50-day moving average to confirm that in all the indices in late July. And then last week, it went up to the 200-day moving average and tried to pierce it, couldn't, and failed. So if you couldn't get more technical than that, and that's exactly what, Nicole, you and I have been talking about, is these trading ranges that are very tradable if you know what you're doing, but for long-term investment, very harrowing.
Yeah, absolutely. I mean, I credited you from stepping in and buying ARK, a name that had been beaten down for that ETF, that innovation fund, Kathy Wood's fund, and it was sort of out of favor, and you stepped in, you bought it. When I spoke to you just recently, I asked you about, because it had done so well since we spoke, and these are near-term trades we've been talking about, and you said, well, I just recently sold it, and you basically sold it before the sell-off. So the technicals are working for you, and congratulations to you on that. So that was some good news. Why is cash king now?
Well, if you just look at the dollar right here, it's trading close to the highs, and it's a flight to safety. And so if you're looking to raise cash, you're in one of the best assets at the moment. And of course, if you want to put that money in the bank, you actually might get a little bit of interest rate on it. So it's almost a guaranteed return right now, and that could stay the case for a while. Doesn't do very much good, though, for people who, A, want to trade, and B, people who have long-term investments or want to invest at these levels. So I would say keep a part of it in cash, but we're always shopping, and we kind of have a new theme since last we spoke to be looking at, because just like stocks had bottomed, many commodities have looked to be bottoming right now in an environment where we have a new condition, which is drought, unprecedented drought. Yeah. In areas like Yangtze, even in the China River, the banks are so low as that they can't even get ships in and out. And of course, as soon as you hear that, what do you hear? Commodity prices are going to get backlogged, and there's going to be bottlenecks, and the prices will go up.
Yeah. I mean, we've been talking about drought right here in Long Island, where people are told not to water their lawns. There's concern here. When I said it was raining in New York, I was going to put a sad face, but right away I thought about how we do have a drought situation, and probably a good thing. We need some rain around here. That being said, tell me about turning your attention to some of the names that you put here, such as Deere, Lockheed Martin, and others.
Well, Lockheed Martin, of course, is a more defensive play, considering the geopolitical situation. But it is not immune to a market sell-off, which is what we saw today. So it opened up well and looked like it was going to continue to rally, and then turn south with the rest of the market. And the same thing with John Deere. And John Deere, I would be less willing to get into unless we start to see some kind of a stabilization in the market. And I just want to say, if we look again back to those charts, just SPY right here, 410 is about 50% from the 390 rally to the 430 rally. In IWM, we have 190 as the same sort of 50% move from 165 up to about where it went to, which is like 201, 202. So essentially right now, these are the levels that have to hold. If they hold, and the reason why I mention them is then I would shop for things that have been relatively outperforming, like a John Deere. But I'm right now, again, back to focused in the commodity space. I always am, but I'm back to it even more so now because they're cheaper.
Understood. And Scorpio Tankers falls in there?
Well, yes. I mean, going back to what we just said about ships having some kind of a bottleneck because of not being able to get out with drought. I mean, that's extraordinary to me. So Scorpio Tankers would be a classic case, and that has actually done well all year. It had a little correction, been consolidating, but that looks like to me it could go up to about 48. And with that, along with that, in that sort of energy space, we're also looking just at a pure oil play here. If you want to look at USO, right now, that had a good sell-off, and in terms of crude prices, it went to $90 a barrel, a little less, but it's back around 90, which is your bottom line support. So you have a good risk there. And also in the energy space, you want to look at coal, TECK, tech, is another one that's sitting right on major moving averages. So this is the kind of thing that if you're a trader, you kind of go, wow, all right, let me get in. I know right away if I'm wrong, and as soon as I get any kind of decent move, let me lock in profit and say goodbye.
Yeah, yeah. And then straight over to some of the ETFs that are on your mind. You have the China large cap ETF, the Invesco DBE Ag Fund. I mean, as we look at what's been going on in China, we've seen obviously slowing more than people expected as we await our own GDP durable goods sentiment this week. But why the China ETF now?
It's interesting because I remember very well when I came to see you on the stock exchange, we talked about China, and it had a big move up from then, and now it's sold off. So I'm less excited about it, except for the fact in terms of monetary policy, they are easing while we're tightening. And that was my main interest, because in 2008, they well outperformed the United States market because they had a different monetary policy. So eyes are there, but not a big rush, only because they do have so many issues, including this bottleneck was going to impact them as well, particularly with inflation. They've had very low inflation. Moving over to the ags, again, cheap. They've come off so much. But wheat right now, we've got our eyes on it, especially if you look at WEAT. And, I like to talk about the ETFs because many people are afraid to trade the futures. That clears 815. Yeah. DBA is back over 20. That's a very solid support line. Corn looks like it could go up. Soybeans started blasting off today. These are all great for commodities trades and for short-term to intermediate-term investments, but they're really terrible for the macro.
Just give me a few seconds on September. It's notoriously not a great month for trading.
Oh yeah, we've had some really big sell-offs in. I am old enough to remember 1987, but yeah, the September right now. Of course, we've got Jackson Hole coming up. The Fed clearly this misinterpretation that somehow they were going to pivot because of some weaker numbers in terms of economic stats turned out obviously not to be the case, and they do have their eye on that. So I think if we continue in that vein of higher interest rates, potential tax raises, more inflation, maybe weaker housing continuing, especially now the high season's over, and any flip in the labor market, it could be a very tough September.
Mish, thank you. Mish Schneider, wonderful to see you, Director of Trading Education and Research at MarketGauge.com. Thank you.